Hi, this is Takatoshi Shibayama, host of the Future Design Podcast. In this episode, we have Peter DeMeo, the global sales leader of IBM Digital Assets team. He joins us in his trademark look, dressed up as a cyber hacker, and he talks to us about how they think and how they work into our computer systems. The conversation got heated into cryptocurrency exchange hacks, investments, decentralized finance, and even quantum computing. Obviously, the mask had to come off. Peter shares with us a plethora of insights into the world of cryptocurrency and cybersecurity. So stick around to the end. So yesterday, I read that the crypto exchange Upbit got hacked by an insider. What do you know about that kind of stuff?
Well, it's funny you should ask that, actually. When it comes to these exchanges, it often is people that you don't expect, perhaps wearing a suit. And they're the ones actually causing a lot of trouble, right?
Right.
I think for Upbit, we read that it was a transfer of the assets from, let's say, the hot to the cold, and one was diverted, big Ethereum was diverted over to, unknown wallet. Clearly, somebody knew what was going on. They were obviously understanding of the timing, and they knew, exactly from a procedural perspective, how to overcome the internal controls that were in place. And so Upbit learned a hard lesson yesterday as well. BitThumb up in Korea as well. We heard there's possibly earlier this year was also an insider attack.
Yeah, CoinCheck.
Japan.
CoinCheck.
Yeah. So it's, from our perspective at IBM, we often think about it, it's, sure, the external people you have to worry about, but it's actually the internal people you have to really worry about, right? And when it comes to let's say custody, most people today, what is 87, 90% of people store their crypto and their tokens, on an exchange, right? Yeah, and they're not really your tokens anymore when you do that. They're all commingled assets.
Definitely. And nobody owns the private keys.
Well, the exchange does. Yeah. Maybe through some social engineering, somebody else will. I mean, I think I just saw a video the other day where a woman just called, and she called a help desk for Verizon, a telephone company in the U.S., and she had this on her laptop this crying baby sound, and she just completely socially engineered the help desk. They of the guy who was with her, so she was demonstrating, right? They reset his account and took him off of it. So then she took over his account and was able to, essentially start to steal his identity, right? And then, of course, do other things as well. So social engineering is kind of a big problem. And that's actually one of the major attack vectors that, people see when it comes to a lot of these types of these hacks. And I think, going back to BitThumb for a moment, that was, I think they're the help desk, actually. They were able to get access to, ultimately, the wallet keys because of the system, because of the laptop that CSR had. It probably shouldn't have, but it had access. And so, that's a major, major concern, is people can just be fooled into, giving access. But more importantly, though, are those that already have the access, the administrators, the privileged developers. I mean, I met with a very large company in Japan, and we were going through all the different security procedures and processes and systems, et cetera. And at the very end, this guy, he's really, really proud. He's like the lead engineer, and he's really proud of everything. I said, well, so it's like, his name is Arun. It's like, Arun, who's guarding against you? I mean, you know everything, right? And he just kind of smiled, and I'm like, that's who we protect against. You know what I mean? It's really you. It's the privileged developer. It's the privileged administrator, right? Those folks who can actually do a lot of damage, and perhaps, like we saw at Upbit, can really time things in a way that no one could really, they can cover their tracks and no one can really catch them, if you will.
Because the hot wallet addresses are pretty visible to anybody, right? So because if you own an account on any of these crypto exchanges and you're sending Bitcoin or Ethereum, whatever it is, you have that address. So you can do an analysis. Crypto is so transparent. So you could analyze where all these Bitcoins are going. Yeah. So if a lot of Bitcoins are going into one particular address, and it's from a particular exchange, then you have full visibility of how much this exchange has of Bitcoins and other crypto tokens. So that's where I think a lot of the is vulnerable too. And also with these crypto exchanges, I mean, these well, in the beginning there was like a lot of crypto kids who started exchanges, and all of a sudden they see so many Bitcoins coming into their wallet, and it probably kind of clouds their judgments too, right?
Well, I'd say clouds their judgments, but I would also suggest that the way that they built these crypto exchanges were not necessarily done with the best systems engineering skills and security engineering skills either. I think there's a lot of sort of slap it together, make as much money as possible, and then from there, let's just cross your fingers you don't get hacked.
Yeah, I mean, there's a lot of companies that sell white label crypto exchanges, and there's no you can buy crypto exchanges like that if you have money, and start your own, slap on bit whatever, digi something, whatever you want to call it, and start your own crypto exchange. And then if you don't have the internal policies in place, if you don't have like a proper cybersecurity team and all these like things that are necessary to run these exchanges, right? I was talking to a big crypto exchange a couple of days ago, and they said they have teams of 20, 30 people just on cybersecurity, and you have like a huge compliance team and all these. They said they spent probably nearly 50 to 60% on like compliance and cybersecurity of their total cost.
Wow, that's
insane.
That is, well, it's good too, right?
Yeah,
because
exactly.
They're professionals, but not all are like that. Yeah, I think this also extends into kind of just getting back to we're seeing a lot of not just cryptocurrencies but also now tokens for the market seems to be shifting around to like tracking securities or representing securities like stocks and bonds and equities, etc. Mortgages as tokens, right? And you have a lot of permission blockchains that are coming into play, and I guess to some degree you still have the tokenized artwork stuff, and all those other things that people like to talk about, fractional ownership, whatever. But they all have that common concern, which is around the private key, right? And making sure it's it's kept. And if most people store their private keys on exchanges, I would say the second largest way to store it is on these little consumer grade devices,
Ledger Nanos and
Trezors and stuff like that. Yeah, and then it's always all of those companies kind of like they fight each other, trying to find out like who's got the biggest attack vector, etc. And yeah, you could argue. You could look at each one of them and you can say, okay, yeah, I can see how to defeat that. I can do a address spoofing on that one, or I can do an evil maid attack on the supply chain of the other. But actually, it's like maybe it's not really hacking is the biggest concern. Have you ever tried backing one of these devices up?
Yeah, it's a nightmare.
or you have people that store the stuff, put it in a vault for years, and they haven't done any firmware upgrades. And when it gets time to do that firmware upgrade, it doesn't work.
Yeah.
And now you have no longer access, or the memory, that is in these chips. It's like consumer grade stuff that it may not last that well, or perhaps it just wasn't manufactured properly. There's so many ways to lose your assets, in these consumer grade devices.
Yeah.
And of course, we can talk about paper wallets and so forth. And I think they also have some of their own concerns too. So then that sort of gets you to then what's left. That's third-party custody. And, of course, today we're seeing third-party custody becoming more and more important as institutional players come in. But now the exchanges, because they are under pressure to be regulated, and they also have Financial Action Task Force kinds of regulations that they need to adhere to as well, like the travel rule and some other things. So custody is kind of becoming more and more of a bigger deal. And those custodians, well, not all custodians are created equally, right? And a lot of it's due to the technology choices that they make too, as well as sort of the professionalism and how their internal policies and controls could be, thwarted by, again, malicious insiders.
Because it's always about people, right?
It really does.
It doesn't really matter if it's third party or you do it yourself. I mean, if you don't have a proper, internal control policy, then you're going to get hacked either way. And it's, I don't know, maybe it's going to be an insider job. So even if the third party custody even has a great technology, the people who are managing it are malicious, then
That's right.
there's no point of having a third party custody. So in the end, I always believe it's always about internal policies and like corporate governance, and those are the one that's the most important part that I always try to see in a company or an exchange. But for most people, you can't figure that out. If I'm a regular Joe Schmo, I want to trade crypto, and I go onto Binance or Huobi or whatever it is, I'm not going to be asking what's your custody solution, right? I mean, nobody asks that. Even if you're trading on equity on Saxo Bank, you're not asking Interactive Brokers or Saxo Bank about what their custody situation is, right?
Well, and it also begs the question about, do they really want to? Because a third-party custody solution, or even one that's let's say in case of like a Binance or something, they have their own, or Huobi, it invariably involves multi-party authorizations. Okay, now it may or may not be multi-sig per se, but the bottom line is that if you want to make a trade, it's not like instantaneous. And when I've talked to people that build these exchanges, like you mentioned earlier, the white label exchanges, I have some friends that's their business, and they kind of pretty much say, the traders really aren't interested, in additional checks, believe it or not. And I thought that was somewhat counterintuitive, but they want to have the ability to trade 24/7. They do not want to have to wait on anybody.
It's a matchmaking engine.
Yeah.
That's the most important part.
That's most important. And the other thing too is that some of the exchanges that I've spoken to, they're like, well, then I would have to pass the cost of the custody onward, because I don't want my customers thinking that I'm raising prices for transaction fees, whatever, because of the custody. So I'd have to offer them sort of a premium service if that's what they really wanted, And I think there is a market for that. I think there's a market for, I want, let's say, a truly hot wallet. I don't want any constraints. And then there's going to be maybe a warmish wallet that basically some policies are tied to, some thresholds are tied to, some rules are tied to, some multiple approvals. Perhaps the trade doesn't go through if it's sort of out of bands of your preferences or your profile, and maybe you get an email or something. There's ways to sort of like throttle it down a little bit. And that could be a premium service that they could charge for. So I think those kinds of things are sort of happening, for exchanges. But what's interesting is it'll be curious as to whether or not those who are custodying their keys on the exchanges really take that up. It remains to be seen. And I guess I want to go back to one of the things you said earlier. When you are trying to figure out, like, okay, I'm on this exchange and I'm not going to ask about their custody solution. Maybe you should. And a lot of these custody solutions, they focus on how many approvers they have, like M of N or multiple quorums of M and so forth, right? And there's different techniques, whether you're doing sham or secret sharing, or you just have different authorizations off-chain, or whether you have on-chain multisig, or whether you have multi-party computation, sharded keys that everyone has, but they don't have to bring them together to sign a transaction. Now, that's really good stuff, right?
But why so complicated? So, like, if I trade shares on Saxo or any internet securities firm, and then probably it goes directly to the custody, I never heard of any. Maybe you can tell me, but like I never heard of like all these complicated stuff going on in the background to do, kind of custody my shares or bonds that I trade, right? So how is that different from like regular? How is crypto custody different from regular custody of securities? Because I don't hear like internal hacks. I don't hear external hacks to that like scale that we hear in crypto. I mean. There was an analysis by Cipher Analysis, and this year alone, up until September, they said there was about $4 billion worth of market value of crypto that was hacked this year. That's massive.
Yeah, I think most of that though is going to be off exchanges.
Yeah,
I haven't really heard of, at least the top tier custodians really, getting hacked. And I spent quite a lot of time talking with them. About their different solutions. I mean, at the end of the day, it's like this trade-off between ease of use and how secure your funds are going to be. Okay, that's a trade-off that everybody has to deal with. And most of the third-party custodians try to strike a good balance there. And heretofore, it's really around, when I think about custodians, I look at it from the perspective of like cold versus hot or warm and then the number or types of asset classes they support. So whether it's just cryptocurrencies, and or token of various types, and how well they do all of that, and what techniques they use to do that sort of thing, right? So these custodians, again, is getting back to sort of like you had mentioned earlier, the sort of the attack vectors are things you don't even ask them. One is all the signing stuff, okay, and there's many technologies to do that. But what people don't really focus on are the other two major attack vectors when it comes to custodians. One is the administration of the platform itself, and so often is the case, you actually have these administrators that are like, they have massive amounts of power, right? And it's unchecked power. It's not like there's like two of them working or three of them in a box, sort of checking each other, like separation of duties and things. They just have a lot of power, right? Yeah. And nobody asks those questions, and they could easily cover their tracks, right? They don't decide, maybe they don't want to do these certain user account actions or key governance actions. Maybe, for example, the key rotation should be every 15 minutes. Well, maybe in my case, it's going to be 0. I'm just not going to rotate the key. Okay. And then I'm going to go ahead and create this wallet, and I'm going to open up a terminal session, and I'm going to go ahead, collect the memory and search for the seed material. And then I'm going to open up another wallet using that seed. And at some point I might decide to move that crypto out. Right. So that's an administrator of these custody solutions, or quite honestly, also exchanges too. And then of course you have the operators. These are in the traditional cold storage based approaches to storing crypto, whether again at an exchange, because they obviously have a lot of cold storage, but also at a custody provider too. The human attack vector and the amount of time is the big trade-off there, right? So anybody that has access to the actual storage device and the private key, like that's a huge attack vector, right? Even if it's been sharded, they can still call their buddies up. So you really think about like exactly how do the internal controls, back to your point about people, right? How does that actually work? And it's a big concern, and it also is a scalability concern. I mean, if you're looking to try to bring more and more assets to bear, and you want to be able to support more online use of those assets, especially if you want to try to monetize them, let's say through staking or something that, or lending and so forth, that you would need to have access, then traditional cold storage with all the people isn't going to really work. Even if you do it multiple times a day, you're just creating more and more opportunities for collusion and loss of funds, right? So
yeah, because every time there's a lot of high volume, you have to have people every time getting tokens out from a cold wallet, which is offline, onto an online hot wallet, and then they do this every single day, right?
Multiple times, yeah. And that's kind of like how that's sort of the state of the market, right? And what we're seeing is that when Coinbase decided to do Tezos staking, right? They have a primarily cold storage based solution, right? So the way they solved that problem was, I thought, very innovative. They created sort of their own Tezos token that they own, okay, and they control that on a hot wallet, and they have their Fort Knox and what have you to sort of keep it secure. They get the baking rewards, and then they share those with their customers, and their customers, of course, if they were hacked, not the customers hacked, but if Coinbase was hacked, they would not, the customers would not lose their funds. Coinbase would, because Coinbase is in fact it's their tokens basically. Yeah. So they've sort of taken it over. That's cool, but then Coinbase has really taken on a lot of liability, right? Yeah. And is that the best way to do it? There could be ways perhaps you can keep these assets in a cold storage state, completely offline, but then using policy that's immutable, meaning you can't change it. So if you're an administrator, an operator, or an approver, you just have to follow the policy, the workflows, you can't change them. If you have all that in place, right, and you have certain thresholds and rules and things of that nature, you could, in fact, just bring on the blockchain assets online for signing when you need them, just when you need them, and no time before or afterwards, right? Sort of like a on-demand concept with a warm wallet.
So you mean like you have strict policies in place, and then you have multiple people perhaps, take the tokens out from the cold wallet to the hot wallet to stake and then put it back in, basically. Is that what you're saying?
Well, not actually conceptually, but take the people out of it. So in fact, in this case, all of the blockchain assets would be encrypted, and they would be sitting, let's say in a storage device, if you will, okay? Enterprise class storage device, itself encrypted. right? So you have some multiple layers. Not that you really need multiple layers, but you would have multiple layers of encryption, right? So if you had an ability though to, if a transaction comes, like a withdrawal transaction comes through, and you have, okay, I have an authentication service. The authentication service has the pub keys of the people who have made that withdrawal, like the fund manager and so forth.
Public keys, right?
Public keys, yeah. And they have a second factor, and they have some, that's what they have, and then you tie it back to what they know. So you got some questions and who they are. Maybe there's a biometric. So is it a mutable sort of like smart contract that says, okay, this is you, right? And then based upon that transaction and that particular user or set of users that are involved in that transaction, there's a profile, all right? And that profile, there's some set of rules that are associated with it, right? So for this set, I'm going to, do X, Y, and Z, maybe send an email or something like that, or have to be under a certain threshold, whatever, rate limits, volume, time locks, that kind of stuff, right? And those rules would be executed in accordance with that policy specifically for that transaction. And then the approvers, it would set up, well, then what is the approval chain for this transaction? Could be anything, really. Mostly going to be multi-party, multi-quorum, off-chain. And then those approvers all have to authenticate in a similar fashion, right? And then, of course, the approval process is then executed according to the rules that were laid out in advance. So because it's all, if you will, hard-coded, if you will, you can't change any of it, right? You just have to follow it, right? It's orchestrated workflows. Then when they have, let's say, approved that transaction, again, based upon all these different factors and conditions, you could have a signing service, okay, that has basically inspected all the previous work that everyone has done, making sure that in fact it's all legit. And these different services themselves have keys. And so when the signing service gets the public keys of all these other services and all the rules and all that has passed and everyone's been authenticated, right? You could actually have a stateless service that says, okay, then I will go ahead and do a signing in a hardware basis, like a hardware security module with a secure domain that eliminates side channel attacks, and do the signing of the transaction then. And when I say that, they would pull the encrypted blockchain asset, right, out of that storage, automatically, okay, and push it into the hardware security module, do the signing, discard that asset. They decrypt it, and discard it, and then send back the signed transaction, which goes out to the public blockchain. Well, perhaps it goes to a dashboard or something like that, and beforehand, whatever the situation really is. The idea here is that.
And where are people involved in this, the whole process?
Yeah, so there's the fund manager that made the withdrawal request, right? So they're end user, if you will. Then there's going to be the approvers, okay? The approvers are going to be policy bound by a set of rules, okay? And then presumably there would be a final approval from the fund manager side or an operations, depending on what the setup is, that will say, okay, yep, everyone's signed off, it looks legit, we're good to go. And then finally they would say, okay, right, go. And then it would go through and sign and so forth. But the point is that the accessing of the encrypted blockchain assets that are sitting in the storage, and then the signing of them in a hardware secure boundary would not involve any humans. Okay, and that's the difference between traditional cold storage and the sort of policy-based signing that I just described, is that it's kind of, again, a warmish wallet, if you will. And so you have eliminated the possibility for a human to access the private key material, period. It just doesn't exist. And you can't just insert yourself and fake that, oh, I'm going to fake the fact that all these rules ran. I'm going to fake the authentication. I'm going to fake the signing service, right? Whatever. You can't do any of those things because, let's say in the case of the signing service, the public keys of the other services have to come in, and it knows what those are because when these services have been booted up, okay, they're done so in a trusted and secure way. So they know the signing service knows what those public keys are in advance, and it is or it is not. There's no faking it, and especially if these services are done using protected memory enclaves that limit and severely restrict access, in some cases, eliminate access, right? Then there's no like terminal session, that I mentioned earlier, you could type stuff into, right? It's just not possible. so these attack vectors, one by one, just sort of disappear. And it's through techniques like this where you can really, move away from traditional cold storage and move away from keeping, a lot of your assets between 5-20%, in hot wallets relatively unprotected, right? Yep. You can kind of move away from that too. So in a sense, you could, using, bespoke policy, okay, tune it for transactions on exchanges, tune it for transactions on custody, tune it for transactions, on these permission blockchains doing tracking, stocks and bonds. You can do it on lending platforms. It really could be applied.
How long does the whole process take?
I guess it depends on what those policies are, right? So if you have an exchange transaction and in your preferences you specify that you just want to be notified in an email that right, and then as you get the email and maybe a second factor, something secure. At least more secure, you have the choice, right? So yes, you submitted a transaction, but you're going to have to come back and confirm that you really wanted to submit that transaction. That's a pretty low level, or kind of fairly weak, right? But it's convenient. You can get it done fast, right? But if you're talking about like a big transaction, you would not want that level of security tied to like a whale transaction, right? Yeah. So you'd want to get some other folks involved, and so your transaction profile would be different, and as a result, you would have a different performance and different experience in terms of the level of rigor applied to that transaction. And the whole idea here is if you're exchange customer, or you are an institutional investor or hedge fund or something like that to a custodian, you're going to have your own transaction profiles defined, and you're going to have your own ways of approving transactions, right? So the idea here is that, and this gets back to the whole human thing. You want to avoid mistakes. I mean, if you try to shoehorn something into someone's business practices, right? Inevitably, people are going to this doesn't make any sense to me. This is not how we do things, right? And then they'll make a mistake, and then you'll lose stuff, right? So it has to be bespoke. It can't just simply be, this is what we offer you, take it or leave it. At the end of the day, yeah, that works, but maybe it doesn't really work, And so what we believe is that, as these technologies advance, right, the ability to fine-tune and tailor these specifically for transactions at the end user level is really where things have to go. Some things going to be balanced more on ease of use, and other things are going to be balanced more on the security of it.
But I don't really hear many stock exchanges getting hacked. I don't know if you do, if you ever heard of any, but
you mean
it's not that common, right? So so where is crypto custody? It's still, I guess it's like the security level is still not at the level of stock exchange custodies.
Well, these are different beasts. Okay, so traditional asset stocks and bonds are mostly, a lot of them still paper-based. A lot of them have digital records, and a lot of them have, traditional processing. When that means that everybody has their own copy of their own ledgers, if you will, right? There's not a common source of truth, and therefore you have a lot of processes around verification, authorization, validation each step of the way. It takes a long time. And then even the keys are that are used in this process are more of the synchronous nature, so that both parties basically establish a trusted connection, and things go. And if something breaks down, you can just put another key and just do it, start over again, right?
Yeah.
And of course, with blockchain, everything is a bearer instrument in a way. That you have this private key with an asynchronous or PKI way of cryptographically securing them, but and transacting with them. So that creates this weird thing where basically you got to look after that private key that just doesn't exist in the traditional finance world. Yeah. It's just a different context, right? But the benefits of being able to dramatically reduce cost, dramatically increase the transparency of transactions, and the costs, of settlement and things like that, far outweigh these kinds of technical considerations. So it's ultimately going to be a technology solve, and it needs to be built around human processes.
Hi, this is your host Takatoshi Shibayama. Thank you for listening all the way to the end. Now, if you enjoyed or disliked this show, please let me know by writing in the comment section. The only way I can improve or add value to you is through your voices. If there are any topics that you would like me to pick up, please also let me know in the comments. I'd love to start chatting with you all. And if you would like to continue watching the show, please subscribe. Thank you.